Hey everyone, and welcome back to the Deep Dive. Today, we're plunging into inventory.
Uh-huh.
It's a concept that seems, pretty straightforward at first glance, just stuff in a warehouse, right?
Right. Seems simple.
But as we'll uncover, it's actually one of the most dynamic and financially impactful assets a business holds. There are layers of legal, accounting, and strategic complexities hiding just beneath the surface.
Indeed. Inventory is, well, it's one of those really foundational concepts in business. It touches everything from the smallest corner shop right up to multinational corporations.
Yeah.
And understanding it helps us grasp a company's true financial health, its operational efficiency. And you might be surprised, honestly, by how many nuanced rules and fascinating distinctions are involved beyond just, counting items.
Okay, let's unpack this then.
Right.
We've received some incredibly detailed source material on inventory. It covers pretty much everything from what even counts as inventory to how it's valued, how it's tracked.
Yeah, it's comprehensive stuff.
So our mission today is to extract the most important nuggets of knowledge, simplify the complex bits, and give you those aha moments. The ones that make you feel truly well-informed. Get ready to rethink everything you thought you knew about stuff in a warehouse. So, okay, before we get too deep into the weeds, let's start with the absolute basics. When we talk about inventory in a business context, what exactly are we referring to, and why is it such a critical component of nearly every business?
Right. So at its core, inventory refers to assets that a business holds specifically for resale, in the ordinary course of its business.
Yep.
It's a profoundly critical asset because it represents a significant investment. It's money tied up, essentially, that needs to be managed efficiently to generate revenue.
Right, you need to turn it over.
Exactly. Think of it as the lifeblood of any business that sells physical goods, whether they buy them ready-made or produce them themselves. It constantly requires careful counting, accurate valuation, and crucially, precise recording in a company's financial books.
And it's not all just the same stuff, is it? Our source material outlines 4 distinct types. Could you maybe walk us through those and perhaps highlight why these distinctions actually matter?
Absolutely. And they do matter because they represent different stages in a product's life cycle within a business. They really illustrate how an item transforms from its rawest form into something ready for a customer.
Okay.
So first, we have retail inventory. This is probably the most straightforward type. Think of the racks of clothes at your favorite boutique, or maybe the shelves filled with packaged goods at a grocery store.
Yeah, things ready to sell.
Exactly. This is inventory that a business purchases and then resells in substantially the same form it was acquired. There's no significant manufacturing or transformation happening. It's ready for sale pretty much as soon as it arrives at the store or the warehouse.
Got it.
Next is raw materials inventory. Now, this is the starting point, specifically for manufacturers. It's inventory held for use in the production process.
Okay, so the ingredients.
Pretty much. To give you a concrete picture, imagine a furniture maker. Their raw materials would be lumber, rolls of fabric, nails, screws, maybe even the specialized glues they use.
Okay.
These are the basic components waiting to be transformed.
Right, waiting to become something else.
Exactly. Waiting to be touched, cut, sewn, assembled. Then we have work in process inventory, or WIP. This is where things get interesting because it represents a transitional phase. It's neither raw nor finished.
In between.
In between. WIP is inventory that is actively in production but is still incomplete. So for a furniture maker, this might be a chair frame that's already been cut and assembled, perhaps even sanded, but it's not yet upholstered or finished with varnish.
Okay.
It's no longer just raw wood, but it's certainly not a finished product ready for a showroom. It's caught in the middle. And importantly, it's accumulating costs, labor costs, overhead expenses as it progresses through the factory.
That makes sense. Value is being added.
Precisely. And finally, there's finished goods inventory. This is the culmination of the production process for a manufacturer. It's inventory that is fully complete, typically packaged, and ready for immediate sale to the customer. So our fully upholstered, polished, perfectly assembled chair, ready to be shipped out the door, that's finished goods.
The end of the line, ready for the customer.
Exactly. For a manufacturer, this is what they produce and then sell directly to distributors or end users.
That makes perfect sense. It's a really clear journey, actually, from raw components to a customer-ready product, and each stage has its own classification.
So, knowing these types, what's the general rule for deciding if something should even be included in a company's inventory for accounting purposes? Is it just like whatever's physically in your building?
Well, the general rule is quite clear on the surface.
Okay.
Any goods and materials in which the company has legal title should be included in its inventory.
Legal title.
And legal title typically follows physical possession of the goods. So, yeah, if it's in your warehouse and you've paid for it, it's generally yours.
Exactly. However, this is where it gets truly nuanced. There are many, many exceptions and special applications of this rule that we'll need to dive into. It's definitely not always as simple as what's physically on your shelves. And overlooking these distinctions can significantly distort a company's financial picture.
So possession isn't always 9/10 of the law when it comes to inventory ownership, huh? That sounds like a puzzle that could really trip up a lot of businesses.
Okay, you've definitely piqued my curiosity about these exceptions. The simple rule is legal title, usually tied to possession. But our source dives into some really fascinating scenarios where it gets, well, a bit murky. Let's start with goods in transit. When something is literally on the move, halfway across the country or the world, who actually owns it at that precise moment?
Ah, yes, goods in transit. This is a classic example where possession and title can diverge significantly. When goods are being shipped from a seller to a buyer, the transfer of legal title depends entirely on the agreed-upon shipping conditions. What's written in their contract.
The fine print. Exactly. The fine print matters. If no specific conditions are explicitly stated, title generally passes when the seller completes their delivery performance, basically, when they've done everything they're obligated to do to get the goods on their way.
Okay.
The most common terminology you'll encounter here is FOB, stands for free on board.
Right, I've seen that.
And this term specifies exactly where the seller's responsibility for delivery ends and, crucially, where ownership and the risk of loss transfer to the buyer. Let's break down the two main types you'll see.
Okay.
First, FOB shipping point. This means free on-board shipping point. Here, legal title passes to the buyer as soon as the seller delivers the goods to the common carrier. Think of it as the moment the truck pulls away from the seller's loading dock, or maybe when the package is handed over to FedEx or UPS.
Right then and there.
Right then and there. From that exact point on, the goods are considered the buyer's inventory, even if they haven't physically arrived yet. And the critical implication here is that the buyer bears the risk of loss or damage during transit.
Oh.
So if anything happens to those goods while they're en route, it's the buyer's problem, not the seller's. They would need to record those goods as their inventory, even if they're still on a truck somewhere.
So just to be clear, if my company's goods are on a truck marked FOB shipping point, and heaven forbid that truck crashes, that's our problem, not the seller's. Even if we haven't actually seen the goods yet, that's a significant risk.
Precisely. The inventory would be on your company's books from the moment it left the seller's dock. It's yours.
Okay, so what's the alternative?
The alternative is FOB destination. This means free on-board destination. With this term, title passes only when the buyer receives the goods from the common carrier at their specified destination.
Ah, okay, when it lands on my doorstep.
Exactly. So the seller retains legal title and bears the risk of loss during the entire transit period. These distinctions are absolutely crucial for accurate inventory reporting, especially at year-end. You can imagine, right? A lot of goods might be in transit, and they need to be properly accounted for on one company's balance sheet and excluded from the others.
That's a huge difference for liability and reporting. Okay, what about when things go wrong, like shipment of non-conforming goods? Say you ordered blue widgets and green ones show up, or maybe they're damaged. Who owns those unwanted items?
Good question. If a seller ships the wrong goods, or goods that don't conform to the contract specifications, wrong color, wrong size, damage the title actually reverts back to the seller upon rejection by the buyer.
Okay, so I can just send it back, and it's their problem again.
Essentially, yes. Even if the buyer has physical possession of these incorrect or damaged goods for a brief period, maybe while they arrange for their return, they should not be included in the buyer's inventory. They are still the seller's responsibility until properly returned or the issue is resolved. It protects the buyer from being stuck with unwanted inventory and ensures their financial statements reflect only what they truly intend to own and sell.
That makes perfect sense. You shouldn't be on the hook for something you didn't order or that isn't right. What about consigned goods? We see this in art galleries, antique shops, sometimes even small retail outlets. How does ownership work there? It seems like the shop has the goods.
Right, but they don't own them. Consignment arrangements are quite common, especially in retail where a seller, maybe a small artisan, might not want to bear the full risk of purchasing inventory outright. So here, a seller, known as the consignor, delivers goods to an agent, the consignee, to hold and sell on their behalf.
Like the gallery owner.
Exactly. What's crucial here is that the consignor, the artist, in this case, retains legal title and risk of loss, even though the consignee, the gallery, has physical possession of the goods and is displaying them for sale. Therefore, the consignor must continue to include these consigned goods in their own inventory records. Revenue is only recognized by the consignor when the goods are actually sold to a third-party buyer. And title passes directly from the consignor to that third-party buyer, completely bypassing the consignee as an owner. The consignee simply earns a commission on the sale.
So that antique store is selling my old lamp. That lamp is still my inventory on my books until it actually sells, even if it's sitting in their shop window.
Yeah.
It's like they're just an extended showroom for my stuff.
Got it. Okay, what about public warehouses? That sounds like just a storage facility, but there's a specific ownership rule here too, right?
Yes, and this one highlights the importance of documentation over mere physical presence. Goods stored in a public warehouse, when evidenced by a formal warehouse receipt, should be included in the inventory of the company holding that receipt.
The paper trail is key. The paper trail is the key. The receipt itself legally evidences title to the goods, even if the owner doesn't have physical possession of them. It's a clear proof of ownership that overrides the lack of direct physical control. It's essential for accurate record keeping. Think about commodities trading. A trader might own tons of grain they've never physically seen. They just hold the warehouse receipts.
Intriguing. And then there's sales with a mandatory buyback. That sounds like a complicated it feels like a sale, but not really a sale. How do those work for inventory?
It can be quite a complex arrangement, often linked to financing. Sometimes a seller might transfer goods to a buyer, but is simultaneously required by contract to repurchase those exact goods from the buyer at a later date, often at a set price.
Okay.
In such cases, despite legal title having temporarily passed to the buyer on paper, the seller must still include those goods in their inventory.
Even though the buyer technically owns them for a bit.
Right. Because the mandatory repurchase obligation means the economic risks and rewards of ownership never truly transferred away from the original seller. It's effectively a financing deal using inventory as collateral rather than a true sale or divestment. It's crucial for portraying the true financial substance of the transaction and prevents the seller from artificially reducing their reported inventory.
That makes sense. It's about economic reality, not just legal form. And finally, installment sales. This sounds like buy now, pay later, but with inventory implications. If someone is paying off a big purchase over time, do they own it immediately, or does the seller retain some claim?
Correct. It relates to when the sale is truly considered complete for inventory purposes. If a seller sells goods on an installment basis, but retains legal title as security for the loan, meaning they still technically owe it, until the buyer pays it all off, those goods should be included in the seller's inventory if, and this is the key part, the percentage of uncollectible debts cannot be reliably estimated.
So if they have no idea how many people might default.
Exactly. If the seller has no good way to predict how many people will default, they keep the inventory on their books because the sale isn't truly assured from an economic perspective. However, if that percentage can be reliably estimated, maybe based on past experience or industry data, then the transaction is treated as a completed sale at the time of the installment agreement. And an allowance for uncollectible debts is recorded, like a provision for bad debt. This prevents a company from indefinitely holding inventory on its books when it's effectively sold, just not yet fully paid for, providing a more accurate picture of current assets and potential losses.
Wow, so many twists and turns. It really shows that defining inventory isn't always as simple as looking in the back room. There's a lot of legal and financial nuance to who truly owns the stuff, and it has significant implications for a company's balance sheet. All right, we figured out what counts as inventory and critically who owns it in all these different scenarios. Now, how do businesses actually put a value on all this stuff for their financial statements? Our source says U.S. GAAP generally requires inventory to be stated at its cost. So what exactly is cost in this context? Is it just what I paid for it, like the invoice price?
Good question. When we talk about inventory cost, it's generally broader than just the sticker price you paid for the item itself. It's defined as the price paid or consideration given to acquire an asset. So yes, the purchase price is the starting point. But it also includes other costs necessary to get that inventory ready for sale. Think about things like freight and charges to get it to your warehouse, customs duties if it's imported, maybe even some direct labor costs if you're a manufacturer putting things together. It's the sum of expenditures and charges, direct and indirect, in bringing goods to their existing condition and location.
So all the costs to get it onto my shelf, ready to go.
Pretty much. Now, what's crucial here is a concept tied to conservatism. If a company expects to recover its original costs plus earn a normal profit from selling that inventory in the ordinary course of business, they typically don't recognize the loss, even if the replacement cost of what it would cost to buy that item today has fallen.
Right. So if I bought widgets for $10 each, and now the price to replace them has dropped to $8, but I still fully expect to sell my existing widgets for, say, $15, I don't have to write down their value.
Correct. As long as you expect to recover your cost, $10, and make your normal profit, you don't preemptively record a loss just because the replacement market price dipped. This maintains the historical cost principle unless there's evidence of impairment.
Okay, that makes sense from a don't predict bad things unless they're likely perspective. But then the source talks pretty extensively about departures from the cost basis. When would a company not value inventory at cost? When does that rule get broken?
This is where the principle of conservatism really kicks in, compelling companies to be prudent and recognize losses when they become probable. If the utility or value of goods is no longer as great as their cost, maybe they're damaged, obsolete, out of fashion, or market prices have genuinely collapsed, you must reduce the inventory's value below its original cost.
You have to face reality.
You have to face reality.
Yeah.
The core purpose is to recognize a probable loss in the period it occurred, not wait until you eventually sell it at a loss. This ensures that financial statements reflect economic reality promptly and aligns with the matching principle, matching losses with the period they happen.
Okay, and how does this happen? What are the main scenarios?
There are two main scenarios for these departures from the cost basis outlined in our sources. First, a very specific one: precious metals and farm products. Some unique types of inventory, like gold, silver, other precious metals, and certain agricultural products, like corn or wheat, are often valued at their net realizable value, NRV.
NRV, what's that again?
Net realizable value. It's simply their estimated net selling price minus any costs to complete and dispose of the inventory. So what you can sell it for, less the cost to sell it.
Okay. Why this special treatment?
It applies when there's an effective government-controlled market at a fixed monetary value, like with some commodities, or when they have immediate marketability at quoted prices, think gold, are unit interchangeable. 1 ounce of gold is like another, and it's practically impossible or meaningless to determine their appropriate individual historical costs. These are exceptions driven by their highly liquid and standardized market characteristics, making current market value a much more relevant measure than historical cost.
Gotcha. So that's the niche case. What's the more common one?
The much broader and more common departure involves applying the rules of lower of cost or market, LCM, and lower of cost and net realizable value, LCA-NRV. As we discussed, the core idea is simple. If the inventory's value has declined below what you paid for it, you must write it down.
So back to my widget example. If my $10 widget is now only expected to sell for $7, netting me, say, $6 after selling costs, I have to reflect that loss now, right? Not when I actually sell it for $7.
Exactly. You'd compare your costs, $10, to its current value based on LCM or LCA-NRV rules, which we'll get into, and record it at the lower amount. That difference is recognized as a loss in the current period. It reflects economic reality promptly, ensuring that future periods aren't burdened by losses that actually occurred today.
And you mentioned something really important earlier under U.S. GAAP. These write-downs are permanent.
That's correct. Reversals of inventory write-downs are prohibited under U.S. GAAP. Once you write it down, it stays written down on your books, even if its market value recovers later.
Right.
It's a very conservative stance, designed to prevent companies from manipulating earnings by writing down inventory in bad times and then writing it back up when things look better. It ensures a consistently prudent view. Once the loss is recognized, it's recognized.
That's a really big deal for financial reporting. Consistency over potential recovery.
Okay, so how do we actually calculate this lower of cost or market LCM? You said there's more to market than just a simple current price.
You're absolutely right. It's not just a single number. For LCM, which specifically applies when inventory is costed using either LIFO or the retail inventory method, we'll discuss those later, you have to calculate a constrained market value. It's designed to balance realism with preventing excessive future profit smoothing.
Okay, constrained how?
To determine market value under LCM, you identify the middle value of 3 specific figures. Number 1, replacement cost. This is what it would cost your company to purchase or reproduce the exact item on the valuation date. This is often your first thought for market value.
Makes sense. Number 2, market ceiling. This is the net realizable value, NRV, the estimated net selling price minus any cost to complete the item and dispose of it, like shipping or sales commissions. This sets an upper limit. It ensures you don't value inventory above what it could realistically be sold for, even if the replacement cost happens to be higher for some reason.
Okay, so you can't value it higher than you can sell it for. Logical.
Logical. And number 3, market floor. This is the market ceiling, NRV, minus a normal profit margin. This sets a lower limit. It prevents valuing inventory so low that future periods realize more than a normal profit on its sale. It basically ensures that future periods don't get an artificially inflated profit simply because of an excessive write-down today.
Ah, okay. So it puts bounds on the valuation.
Exactly. So you take these 3 values, replacement cost, market ceiling, NRV, and market floor, NRV minus normal profit. You find the middle value of those 3. That middle value becomes your designated market value for the LCM calculation. Then you compare that calculated market value to your original cost, and you choose the lower of the 2. That's the final value at which your inventory will be recorded on the balance sheet.
Wow. Okay, let's try a quick example from the source. Say item 1 cost $20.50, replacement $19, selling price $25, completion $1, normal profit $6.
Okay, ceiling is NRV, $25.1, $1 is $24. Floor is ceiling profit equals $24, $6 is $18.
Right.
Now, replacement cost is $19. Is $19 between the floor, $18, and the ceiling, $24.
Yes, it is.
So $19 is the median, that's our market. Now compare market $19 to cost $20.50, which is lower.
Market $19.
Exactly. So you value item 1 at $19. Let's try item 2. Cost $23.6, replacement $20, selling price $30, completion $2, profit $7.
Okay, ceiling $30, $2 it was $28, floor equals $28, $7 is $21.
No, it's below the floor.
Exactly. Since it's below the floor, our designated market value becomes the floor itself, which is $21.
Ah, so the floor acts as a minimum for the market value in this calculation.
Yeah.
Precisely. Now compare market $21 to cost $26. Lower is
Market $21.
so value item 2 at $21. You see how the ceiling and floor constrain the replacement cost to arrive at the market figure?
I do. That's incredibly detailed. So the market value isn't just one number. It's this constrained median that tries to balance realism with preventing excessive future profit smoothing. It's truly an application of accounting conservatism in action. Now, what about the other one? Lower of cost and net realizable value, LCA and RV. When is that used, and how does it differ from this complex LCM?
Good question. The LCNRV method is used for all inventory that is not costed using LIFO or the retail inventory method. So basically, if you're using FIFO or average cost methods, you'll use LCNRV.
Okay, so it covers the other main methods. And is it simpler?
Yes, it's conceptually simpler than LCM because it doesn't involve the replacement cost or the market floor constraints at all. You just compare 2 numbers, the item's original cost and its net realizable value, NRV, which again is simply the estimated net selling price minus costs to complete and dispose. You then simply choose the lower of those 2 values.
So it's basically just cost versus the ceiling NRV from the LCM calculation.
Exactly. You skip the whole replacement cost and floor calculation. Let's look at example 2. Item 1, cost $28.50. Selling price $30, completion $3.
Okay, NRV equals $30, $3 is $27.
Right. Now compare cost, $28.50 to NRV, $27. Lower is
NRV, $27.
so you value it at $27. Simple as that. Item 2, cost $21, selling price $26, completion $4.
NRV, you feel $26 equals $22.
Compare cost, $21 to NRV, $22. Lower
So
it.
you value it at $21. No write-down needed for that one.
Got it. So LCNRV is basically cost versus NRV, the ceiling, while LCM is cost versus that more complex median calculation involving replacement, ceiling, and floor. Very clear. And presumably any significant write-downs stemming from either of these calculations need to be made clear to anyone looking at a company's financials, right? You can't just bury a big loss. Absolutely not. Transparency is crucial in financial reporting. Substantial and unusual losses from inventory write-downs must be disclosed separately, either in the income statement or in the notes to the financial statements. This gives users a clear understanding of the impact and why it occurred.
Okay.
Smaller, more routine losses, maybe due to normal spoilage, are typically just included within the cost of goods sold calculation. Also, consistency in the valuation method is paramount. A company must stick to the method it chooses, FIFO, LIFO, average cost, etc., year after year.
Right, can't just switch back and forth.
Exactly. And any significant change in how inventory is measured must be fully disclosed, along with explaining its material effect on the company's net income. This ensures comparability across periods and prevents companies from switching methods simply to manage how their earnings look.
So we know what inventory is, who owns it, and how to value it, including those potential write-downs. But how do companies actually keep track of it day to day, especially for businesses with maybe thousands or millions of different items? Our source material talks about two main systems, periodic and perpetual. What's the fundamental difference here in terms of how they operate and, maybe more importantly, what kind of real-time information they provide?
Right, this gets down to the mechanics of tracking. The key distinction lies in when inventory quantities and their associated costs are updated in the accounting records, and consequently, when the cost of goods sold, or COGS as it's commonly abbreviated, is actually determined. It's really about the timing and the level of detail available at any given moment. This profoundly impacts operational decisions like reordering and also financial reporting.
Okay, timing and detail. Let's start with periodic.
Let's start with the periodic inventory system. This is the more traditional and often simpler approach. It's particularly suited for smaller businesses or maybe those with high-volume, low-value goods where continuous, detailed tracking isn't practical or cost-effective.
Okay.
With a periodic system, the quantity of inventory on hand is determined only by conducting a physical count. You actually have to go out and count everything.
Like physically touch every box.
Physically count every box, every item. This is typically done at least annually, maybe quarterly if they need interim financial statements. But the point is, you don't have a running tally in your accounting system day to day. Inventory units and their associated costs are only counted and valued right at the end of the accounting period.
So if I own a small bookstore using this system, I literally have to shut down, say, once a year, maybe New Year's Day, and count every single book from every genre on every shelf just to figure out what I have left and what my sales cost was for the whole year.
Precisely. You might close for a day or two specifically to perform that detailed physical count. It can be quite disruptive. And only after that physical count is complete can you determine the actual cost of goods sold, COGS, for the period.
How do they calculate COGS then if they aren't tracking sales costs as they happen?
They use a formula. It's often called squeezing because COGS is essentially the leftover amount after you account for everything else.
Squeezing, okay.
Yeah, the calculation is straightforward. You take your beginning inventory, what you started the period with, you add all your purchases during the period based on invoices, which gives you your total cost of goods available for sale. Then you subtract your ending inventory, the value derived from that big physical count you just did. The result, the amount that's missing or unaccounted for, is assumed to be your cost of goods sold. So beginning inventory plus purchases ending inventory, COGS. This method, crucially, does not keep a running total of inventory balances or COGS throughout the period. You only know those final numbers after that comprehensive count.
That makes sense for smaller operations where maybe real-time tracking is overkill or just too expensive to implement. But what about larger companies? Like an online retailer that ships hundreds of thousands of items a day. They can't exactly shut down to count. How do they manage?
Exactly. That's where the perpetual inventory system comes in. It's designed for precisely that scenario. With this system, the inventory record for each individual item, every SKU, basically is updated immediately for every purchase and every sale as they occur.
Immediately. Like in real time.
In real time or very close to it.
Mm-hmm.
When you buy something and it arrives at the warehouse, the system updates to show more inventory. When you sell something, the system immediately records the sale and reduces the inventory count and records the cost of goods sold for that specific item at that exact moment. It's all fully integrated, usually through scanning barcodes or RFID tags.
So every time a new product arrives at, say, Amazon's warehouse or someone clicks buy on a book online, the system updates the inventory count and the dollar value right away. That's impressive.
Exactly. It's a continuous running total of inventory balances, both in units and in dollars. This provides an always up-to-date picture of what's on hand and what's been sold.
The benefits seem huge.
Oh, they are. This provides much more current information, which is invaluable for real-time management decision-making. You know exactly when to reorder specific items, you can manage stock levels across multiple locations, and you can quickly track issues like theft or damage almost instantaneously because the system flags discrepancies much faster. This real-time data is absolutely critical for modern supply chains, e-commerce, and really any business that needs precise control over its stock.
That sounds much more complex to implement, though. You'd need sophisticated software, scanners, disciplined processes, but the power you get from it seems immense for big operations. Our source gives journal entry examples that really highlight the operational differences. Can you maybe walk us through those fundamental shifts in the accounting records when a sale or purchase happens under each system?
Of course. The journal entries really show the difference in information flow. Let's look at the operational impact through those entries, which are the fundamental records of a company's financial transactions. Let's take recording a sale. Imagine a company sold 20,000 units for $7 per unit, and those units had originally cost the company $5 per unit.
Okay, 140K revenue, $100K cost.
Right. Now, under the periodic method, when that sale happens, you simply record the CAF received, or accounts receivable, and the sales revenue generated. That's it for now.
Just the sale part.
Just the sale part. There's no immediate entry for the cost of the goods sold or the reduction in the inventory asset account at the point of sale. That COGS calculation happens later at the end of the period using that squeeze formula after the physical count.
So the entry would be?
You debit cash, or accounts receivable, for $140,000 and credit sales revenue for $140,000. Notice, no immediate impact on cost of goods sold or the inventory asset account itself.
Okay, now perpetual.
Under the perpetual method, you record two distinct entries for every single sale. The first entry is the same as the periodic method, recording the revenue.
Debit cash, credit sales for 140K.
Exactly. But then immediately, you make a second entry where the real tracking comes into play. You record the cost of the goods that just walked out the door and reduce your inventory asset.
On the cost side.
Right. You would debit cost of goods sold for $100,000, that's the 20,000 units times their $5 cost, and credit inventory for $100,000, reducing the asset balance.
Okay.
What's truly insightful here is how the perpetual system gives you real-time insight into your profitability on each individual sale, or at least on a daily basis. You know immediately the gross profit for that specific transaction or batch of transactions.
That's powerful. Okay, what about recording a purchase? Well, let's say the company purchased 50,000 units of merchandise for $6 a unit, $300K total.
Okay. Under the periodic method, when you buy inventory, you don't directly increase the inventory account. Instead, you debit a temporary account called purchases. This account just accumulates the total cost of all inventory bought during the period.
So the entry is debit purchases, credit cash, or accounts payable.
Correct. You debit purchases for $300,000 and credit cash, or accounts payable, for $300,000. The purchases account gets closed out at the end of the period when you calculate COGS.
Okay. And perpetual.
Under the perpetual method, when you buy inventory, you directly debit the inventory asset account itself, immediately increasing its balance to reflect the new goods on hand.
Makes sense. So debit inventory, credit cash.
Exactly. You debit inventory for $300,000 and credit cash or accounts payable for $300,000. This clearly shows how the perpetual method keeps the inventory asset account continually up to date, reflecting the actual amount and cost of inventory on hand at any given moment.
That truly makes the difference super clear. The perpetual system provides a live, dynamic look at your stock levels and your profitability as things happen. So, does anyone use a mix of these systems? It seems like perpetual is the dream, especially with modern technology making it easier. But maybe it's not always practical to fully implement for every single nut and bolt a company might have.
Yes, absolutely. Hybrid inventory systems are quite common, especially as businesses grow and their needs evolve, or for different types of inventory within the same company.
How might that work?
Well, some companies might maintain a perpetual record of quantities only. This is often referred to as a modified perpetual system. They use scanners or manual accounts to update the number of units after each sale and purchase, so they always know how many items they physically have. This helps with reordering and stock control.
But not the dollar value.
But they might not continually update the dollar value of those units perpetually. They might apply costs using a periodic method, like weighted average, at the end of the period. This is a compromise that offers some of the operational benefits of perpetual tracking, knowing quantities, without the full complexity of costing every single transaction in real time.
A middle ground.
A middle ground. And it's also really important to note, even most companies using a full perpetual system with all the bells and whistles still perform physical inventory counts.
Even with scanners and real-time data? Why?
Because reality happens. They might do a complete physical inventory once a year, like in the periodic system, or more commonly, they perform cycle counts, counting small sections of the inventory on a rotating basis throughout the year. This acts as a crucial check to ensure the perpetual records are accurate. No matter how sophisticated your computer system is, errors can occur, data entry mistakes happen, items can be damaged and not recorded, or shrinkage due to theft, spoilage, or just being lost can happen.
Right, the system only knows what you tell it.
Exactly. These physical counts reconcile the electronic records with the physical reality on the shelves. They catch discrepancies and ensure the financial statements are truly reflective of the inventory actually on hand. It's that final essential reality check.
It sounds like perpetual is the ideal for most larger businesses, especially with technology making it feasible. But periodic still has its place for simpler operations. And these hybrid models and cycle counts often offer the best of both worlds, real-time data plus a necessary reality check. It's about finding the right balance between information needs, cost, and operational efficiency for a given business, which seems like a constant management challenge. Okay, this next section is where things get really fascinating for me personally, because it delves into how a company's accounting choices they make within the rules, can significantly alter its reported profits and financial position. We've talked about valuing inventory at its cost. But what if you bought the same identical item at different prices over time? For instance, you might buy a batch of widgets at $10. Then a few weeks later, maybe due to supply chain issues or inflation, you buy another batch of the exact same widgets at $12.
Right, a very common scenario.
So if you then sell one of these widgets, how do you decide which cost gets assigned to the item you just sold for financial reporting purposes? Do you use the $10 cost, the $12 cost, some kind of average? Our source calls these cost flow assumptions, and they sound like they can profoundly impact a company's financial story.
This is an absolutely critical area of inventory accounting, precisely because when similar identical goods are purchased at different times and at varying prices, it's often impossible, or at least highly impractical, to physically identify the specific cost of each individual item sold. Imagine a silo full of grain, or a bin full of identical screws, or gallons of gasoline in a storage tank at a refinery. You simply can't tell which specific units were bought first or last.
They all just get mixed together.
They all get mixed together. So instead of trying to track each physical item's exact historical cost, which is often impossible, we make assumptions about how the costs flow through the business. And it's crucial to understand, as you hinted, that these cost flow assumptions do not necessarily have to match the actual physical flow of goods.
That's the key bit, right? The accounting flow doesn't have to match the physical flow.
That's the key bit. The primary objective, according to accounting standards, when choosing a cost flow method, is to select the one that will most clearly reflect periodic income and portray a consistent financial picture to investors and other stakeholders. It's about choosing a systematic and rational allocation method.
Okay. So what are the main methods or assumptions? Is there one that does track specific items?
Yes, there's one method that isn't really an assumption in the same way, and it's good to clarify that up front: the specific identification method.
Okay.
This is the exception to the rule of using assumptions. It's typically used only for inventory items that are not ordinarily interchangeable things that are physically large, unique, or have very high individual value. Think automobiles with unique VINs, custom-made machinery, major pieces of jewelry, or unique pieces of art.
Things you can point to and say, that specific one.
Exactly. For these items, the cost of each individual item is uniquely identified and recorded, perhaps by tagging it or tracking its serial number. When that specific item is sold, its exact known historical cost is matched directly to the revenue from that sale. You know precisely what you paid for that specific car with VIN number XYZ, and that's the cost you recognize when it sells.
That sounds like the most accurate way, matching actual cost to actual revenue.
It is precise in matching cost to revenue. However, it does have a potential downside. It offers an opportunity for income manipulation, especially if the items are similar but were acquired at different costs.
That's so.
Well, imagine a car dealer has two identical cars on the lot, same model, same color, same features. But they bought one 3 months ago for $40,000 and the other last week for $45,000 due to a price increase. If they sell one of these cars today using specific identification, they could choose to deliver the one with the $40,000 cost to show a higher profit for the quarter, or they could deliver the one with the $45,000 cost to show a lower profit, perhaps to manage taxes or smooth earnings, even if the physical cars are identical to the customer.
So if I had two identical antique vases, but I bought one for $10,000 and the other for $12,000, I could essentially choose which cost to record when I sell a vase, even if the physical vases are indistinguishable to the buyer. That's clever, but it definitely sounds like it could be used to manage earnings results.
Exactly, and that's precisely why its use is usually restricted to those truly unique, non-interchangeable items, where such choices are less about manipulation and more about accurately tracking distinct high-value assets. For most businesses dealing with homogeneous products where items are largely interchangeable, we rely on the cost flow assumptions. Let's start with the most intuitive one. FIFO. First in, first out.
FIFO. Okay, this one sounds like it matches physical flow often.
It often does. Under FIFO, the accounting assumption is simply that the first costs inventoried, the costs of the oldest items you purchased, are the first cost transferred out to cost of goods sold when a sale occurs. You assume you're selling your oldest stock first.
So if I run a grocery store and I bought apples on Monday for $1 per pound, then on Wednesday for $1.20, and on Friday for $1.50, if I sell a pound of apples on Saturday, I assume for accounting purposes it's one of the $1 apples I bought first, even if physically I probably put the newest ones on top and grab one of those.
That's the accounting assumption for FIFO. You expense the $1 cost first. And as you noted, this method often aligns well with the physical flow for many businesses, especially those dealing with perishable goods, like your apples, or goods that can become obsolete, like electronics. They naturally want to sell their oldest stock first to minimize spoilage or write-downs.
Right, makes sense for rotation.
Exactly. Now, a key accounting takeaway with FIFO is that your ending inventory will consist of the most recently incurred costs, the $1.20, and $1.50 apples, in your example, would still be on the balance sheet. Because the oldest costs were expensed, the ending inventory balance on your balance sheet will tend to closely approximate the current replacement cost of those items, which many analysts like.
Okay, so ending inventory looks current. What about CADIs?
KGS reflects the older, potentially lower costs. And another very important practical point about FIFO. The ending inventory value and the cost of goods sold amount are the same, whether you use a periodic inventory system or a perpetual inventory system. The calculation comes out identically.
Oh, that simplifies things, unlike some others we might discuss.
Exactly. Unlike LIFO, as we'll see, this consistency simplifies record-keeping considerably for companies using FIFO.
Okay. Now, let's consider the financial statement effects of FIFO. You often hear about this in relation to inflation or rising prices, which, let's face it, has been a common economic scenario lately. How does FIFO perform then?
Right. In a period of rising prices, FIFO generally results in, number one, the highest ending inventory value reported on the balance sheet. Why? Because the oldest, typically lowest costs are assumed to be expensed first, as COGS, leaving the newer, higher costs remaining in your inventory asset balance.
Makes sense. Inventory looks higher value.
Number two, the lowest cost of goods sold reported on the income statement. Again, this is because those older, cheaper costs are the ones being matched against your current sales revenue.
Lower cost, higher profit.
Exactly. Which leads to number three. Consequently, FIFO typically results in the highest net income during periods of rising prices, because a lower COGS leads directly to a higher gross profit and ultimately higher net income before taxes. This can make a company appear more profitable on paper compared to using other methods like LIFO.
So the critical Blinkist insight, maybe, for an investor looking at a company using FIFO during inflation is this. Their reported profits might look strong, maybe the strongest among competitors using different methods. But part of that higher profit might just be so-called holding gains, the difference between the old low cost they're expensing and the current higher value of replacing that inventory. It doesn't necessarily mean their underlying operational efficiency is better, right?
That's a very astute observation. FIFO includes those holding gains in reported income, which LIFO aims to exclude. To illustrate the concept with the Helix Corporation example from the source, they bought inventory in 3 batches, with prices increasing each time. $4.25, $4.50, $4.75. If Helix sells 4,000 units, under FIFO, they would assume those 4,000 units came entirely from the very first lowest cost batch at $4.25. So their cost of goods sold would be $17,000, $4.25, resulting in a higher reported profit and leaving the more expensive $4.50 and $4.75 units in their ending inventory. The detailed calculations are in the source material, but the key is that FIFO pushes the older, lower cost to the income statement first when prices are rising.
Okay, FIFO, highest profit, highest ending inventory in rising prices. Got it. What's the next option? The weighted average method. How does that approach the problem of varying costs?
The weighted average method takes a blending approach. Under this method, the cost assigned to both the units sold, COGS, and the units remaining in ending inventory is the same weighted average cost. This average is calculated for all items available for sale during the period.
How do you calculate that average?
It's calculated by taking the total cost of all inventory available for sale, that includes your beginning inventory costs, plus the cost of all your purchases during the period, and dividing that total cost by the total number of units available for sale, beginning units plus purchased units. This gives you a single average cost per unit.
Okay, one blended cost for everything.
One blended cost for everything that was available during that period. This method is particularly suitable for homogeneous products where specific identification is impossible, and FIFO-LIFO might seem artificial. Think back to those barrels of oil, tons of coal, or piles of gravel where all units are physically indistinguishable and get mixed together. It works most naturally with a periodic inventory system because you're typically calculating that single average cost at the end of the entire period, looking back at all purchases.
And the effect.
This method effectively smooths out the impact of price fluctuations. Since you're averaging all the costs, it gives a middle ground valuation for both COGS and ending inventory. It won't show the highest profit like FIFO and rising prices, nor the lowest like LIFO. It's sort of the steady middle path. Using the Helix example again, you'd calculate the total cost, $40,250, divided by total units, so 9,000, to get an average cost of 4.4722 tools per unit. Then COGS for the 4,000 units sold would be 4,004.47222, and ending inventory for the remaining 5,000 units would be 5,004.47222.
That's a nice steady approach. It definitely smooths things out compared to FIFO. Now, what's the moving average method? How is that different from this weighted average? It sounds similar, but maybe more dynamic, like you said.
It is similar conceptually, but it's applied differently. The moving average method is essentially the weighted average concept, but it's computed dynamically after each purchase. It requires a perpetual inventory system.
Oh, okay. So it's not just one average for the whole period.
Correct. Every time a new batch of inventory is purchased, a new weighted average cost per unit is calculated. This new average is determined by taking the total cost of the inventory currently on hand, the cost of the old balance plus the cost of the new purchase, and dividing it by the total number of units currently on hand, old units plus newly purchased units.
So the average cost moves with each purchase.
Precisely. It moves or changes throughout the period. This makes the cost used for COGS when a sale occurs more current than the simple weighted average method, which uses an average based on the whole period. It reacts to new purchase prices immediately. Because it requires continuous updates after every purchase, it necessitates a perpetual inventory system to track those balances in real time.
So more calculations involved.
Definitely more calculations involved, as the average cost needs recomputing frequently. The result is that the average cost changes dynamically with each new purchase, providing a more up-to-date, albeit still averaged, cost for valuing both sales and the remaining inventory at any point in time. It's a continuous blending process, always reflecting the freshest average cost based on the inventory currently held. The source, example 7, shows how after each purchase for Helix Core, the average cost per unit is recalculated, leading to a COGS and ending inventory slightly different from the simple weighted average.
That's a lot of calculations, but I can see how it stays more current by reacting to each purchase. Okay, now for the big one, the often controversial one, LIFO. Last in, first out. This one always seems to generate a lot of discussion in finance and accounting circles, especially given its significant tax implications in the U.S.
Yes, LIFO definitely warrants careful discussion. Under LIFO, the accounting assumption is the opposite of FIFO. It assumes that the last costs inventory to the costs of the newest items you purchased are the first costs transferred out to cost of goods sold when a sale occurs.
So the most recent costs hit the income statement first.
Exactly. Consequently, your ending inventory reported on the balance sheet will theoretically consist of the oldest costs, potentially costs from many years ago, if inventory levels have been stable or growing.
So using my Apple analogy again, if I bought apples Monday, one day, Wednesday $1.20, and Friday $1.50, and then I sell a pound of apples on Saturday, under LIFO, I assume for accounting that it's one of the $1.50 apples from Friday's purchase that I sold, even if it's physically sitting at the bottom of the bin, and I likely picked an older one from the top.
That's the LIFO accounting assumption. You expense the most recent $1.50 cost first. And what's absolutely crucial to understand here is that LIFO generally does not relate to the actual physical flow of goods for most industries.
Right, unlike FIFO, which often does.
Precisely. Most companies, as we discussed with FIFO, try to sell their oldest goods first in reality to prevent obsolescence, spoilage, or damage. LIFO is largely an accounting convention. Its primary driver, especially in the United States, has historically been its potential tax benefits during periods of rising prices.
Ah, the tax angle. How does that work?
We'll get to the effects in a moment, but it leads directly to a significant and unique rule in the U.S., the LIFO conformity rule. This rule states that if a company chooses to use the LIFO method for calculating its taxable income for federal income tax purposes, which it might do to lower its tax bill during inflation, then it must also use the LIFO method in its GAAP, generally accepted accounting principles, financial statements that it presents to investors, creditors, and the public.
You can't use LIFO for the IRS and FIFO for your shareholders to look more profitable.
Exactly. You have to conform. You must use the same method for both tax reporting and financial reporting if you choose LIFO for taxes. This prevents companies from presenting one picture, lower income, to the tax authorities and a different, potentially more favorable picture, higher income, using FIFO perhaps, to investors. It's a major consideration for companies contemplating LIFO.
Okay, you mentioned LIFO is largely an accounting convention driven by tax benefits and doesn't usually match physical flow. Doesn't that inherently present a less accurate picture of a company's real physical operations to investors? It seems counterintuitive if the goal is clear reporting.
That's a very perceptive question, and it hits on exactly why LIFO is controversial and, notably, is not permitted under International Financial Reporting Standards, IFRS, which are used by many countries outside the U.S.
So the rest of the world mostly doesn't allow LIFO.
Largely, yes. The argument for LIFO from a financial reporting perspective, beyond taxes, is that it arguably provides a better matching of current costs with current revenues on the income statement. By expensing the most recent and, in an inflationary environment, typically highest costs against the revenues generated from recent sales, it arguably gives a more realistic picture of the company's current operating margin or profitability from ongoing operations. It effectively eliminates those holding gains, the profit just from holding inventory while prices rise, that FIFO includes in income.
Okay, so better matching on the income statement is the argument for it.
That's the main conceptual argument. However, the counter-argument, and where the potential distortion lies, is what happens on the balance sheet. LIFO can make the inventory value on the balance sheet significantly out of date and potentially misleadingly low compared to current market values.
How so?
Let's look at the financial statement effects of LIFO, again focusing on periods of rising prices. Number one, LIFO generally results in the lowest ending inventory value reported on the balance sheet. Why? Because the newest, typically highest costs are assumed to be expensed first as COGS, leaving the oldest, lowest costs remaining in your inventory asset balance. If a company has used LIFO for decades during inflationary periods, this balance sheet inventory figure can become massively understated compared to the actual current replacement cost of that inventory. It might represent costs from the 1980s or even earlier.
Wow, so the balance sheet doesn't reflect current value at all.
Not even close, potentially. Number two, it results in the highest cost of goods sold reported on the income statement because it matches the most recent higher costs against current revenues.
Highest cost, lowest profit.
Exactly. Which leads to number three. Consequently, a LIFO typically results in the lowest net income, before taxes, during periods of rising prices. And this is the tax advantage. Lower net income generally means lower taxable income and therefore lower tax payments in inflationary environments. This improves a company's cash flow as they're deferring tax payments.
So LIFO equals lower profit, less tax, but also a potentially very understated inventory value on the balance sheet. It's a trade-off.
It's definitely a trade-off. Better matching on the income statement and tax savings versus a less informative balance sheet.
What happens if a company using LIFO sells more inventory than it buys in a period? You mentioned dipping into old layers.
Yes, that's a key risk or characteristic of LIFO. If sales exceed production or purchases in a given period, the company might have to liquidate older LIFO layers to calculate its cost of goods sold. This is called a LIFO liquidation.
Yeah. And what's the impact of that?
It can lead to a significant distortion of net income in that specific period. Suddenly, those very old, very low costs from past layers are matched against current, potentially high sales revenues. This can result in an unusually high reported profit and a higher tax bill during that specific period simply because of the liquidation, not because of improved operational performance.
So it can create volatility in earnings.
It can, and it also makes LIFO susceptible to income manipulation. A company could potentially manage its reported earnings by intentionally reducing purchases near the end of the year to trigger a LIFO liquidation and temporarily boost profits, or by buying extra inventory to avoid dipping into old layers and keep profits lower.
That adds another layer of complexity for analysts trying to understand the true performance. Okay, so the critical Blinkist insight for an investor looking at a U.S. company using LIFO during inflation might be, their reported profits will likely be lower than a similar FIFO company, meaning they're paying less tax, which is good for cash flow. However, you absolutely must look at the LIFO reserve disclosure, which shows the difference between LIFO inventory value and what it would be under FIFO, to understand how understated their balance sheet inventory is and to adjust for potential LIFO liquidation effects when comparing profits over time or across companies. It requires more digging.
Absolutely. That LIFO reserve disclosure is critical for comparability. You need to adjust for it.
How do these LIFO layers actually work in practice? It sounds a bit like an archaeological dig where you uncover older stuff underneath.
That's a great analogy. An archaeological dig or maybe building up layers of an onion. LIFO requires tracking inventory costs in distinct layers based on when the inventory was acquired.
How does that start?
An initial base year inventory amount is established at its original cost when the company first adopts LIFO. That's your foundational layer. In subsequent years, if the ending inventory quantity is greater than the beginning inventory quantity, it means the company added inventory. Under LIFO, this increase creates a new LIFO layer. This new layer is typically priced using the costs incurred earliest in that current year, or sometimes an average cost for the year depending on the specific LIFO method used, like dollar value LIFO.
So you add a new ring to the onion, priced at this year's cost.
Exactly. You build up layers year after year as inventory grows. Now, if inventory decreases in a year, meaning ending quantity is less than beginning quantity, you have to peel back or liquidate layers to get the cost for COGS. And crucially, you peel back the most recently added LIFO layers first.
Last layer added is the first layer removed.
Precisely. You work backwards through the layers. If the decrease is large enough, you might peel back several recent layers or even dip into the very old base layer, potentially releasing those ancient low costs into COGS.
That makes the record-keeping sound quite complex.
It can be, especially with physical unit LIFO. Now, this layering process also highlights a critical difference between LIFO periodic and LIFO perpetual systems.
Oh. Unlike FIFO, they give different answers.
Yes. Unlike FIFO, LIFO periodic and LIFO perpetual can often result in significantly different cost of goods sold and ending inventory values.
Like that.
It's due to the timing of applying the last-in assumption. Under LIFO periodic, you look at the entire period's purchases and the total sales. You determine the ending inventory quantity first, usually via physical count. Then you assume the cost of that ending inventory comes from the earliest purchases of the period, or base layer, and the remaining cost of goods available for sale becomes your COGS. Effectively, you assume the last costs incurred during the entire period are the first ones assigned to COGS. See example 8 in the source for Helix Core. COGS takes costs from batch 3 first, then batch 2.
Okay, it looks at the whole period.
Under LIFO perpetual, you apply the LIFO assumption at the time of each individual sale, based on the inventory layers on hand at that specific moment. So when a sale occurs, you look at the most recent purchase layer currently in stock and assign its cost to COGS. This can lead to different costs being assigned compared to the periodic method, where you wait until the end of the period to see what the last-in costs ultimately were. Example 8, LIFO perpetual calculation, shows COGS being assigned based on layers available at the time of each sale, resulting in different COGS and ending inventory than LIFO periodic.
That difference is fascinating. The timing of the calculation changes the outcome under LIFO. So the choice between periodic and perpetual matters more if you're using LIFO.
Absolutely. It's a critical distinction. The source also provides that useful comparison table summarizing how FIFO, LIFO, periodic, and average cost methods generally stack up in terms of ending inventory and cost of goods sold, especially in periods of rising prices. It's a good visual cheat sheet.
Yeah, that table is great. FIFO gives the highest ending inventory and the lowest COGS. LIFO periodic gives the lowest ending inventory and highest COGS. And weighted average falls somewhere in between. It really hammers home that the choice of accounting method isn't just a technical detail. It can significantly alter a company's reported financial performance and position, even if the underlying physical transactions are absolutely identical. It emphasizes that the numbers on a financial statement aren't always a purely objective reflection of reality, but rather can be shaped by management's accounting choices within GAAP's permitted methods. It really sounds like there's a whole strategic game being played with these assumptions. Okay, moving into some slightly more advanced territory now, our source mentions dollar value LIFO. This sounds like LIFO, obviously, but with a twist. What's the dollar value part about? It seems like it's trying to make LIFO more practical maybe for companies with huge, sprawling inventories.
That's exactly right. Dollar value LIFO is an evolution, or perhaps a practical adaptation, of the regular LIFO method. It was designed specifically to make LIFO feasible for companies that have a vast number of diverse inventory items, where tracking individual physical units and their specific LIFO layers would be incredibly cumbersome, if not impossible.
Like a big department store or a massive manufacturer.
Precisely. Instead of painstakingly measuring inventory changes in terms of individual physical units, like number of screws, number of shirts, and tracking their unit prices and layers, dollar value LIFO measures inventory changes in terms of total dollars within defined pools of inventory. And then, crucially, it adjusts these dollar changes for changing price levels using a price index.
Ah, so it uses price indexes to deal with inflation within the LIFO calculation.
Exactly. It helps us separate the real physical change in inventory quantity from the change that's just due to price inflation. This aggregation into dollar pools, adjusted by an index, dramatically simplifies the complex task of tracking potentially thousands of individual LIFO layers for different products, but it still retains the core LIFO assumption, last costs in or first cost out for the pool, and allows companies to get those tax benefits we discussed. It essentially allows you to apply LIFO to a pool of inventory measured in dollars rather than by specific product types.
Okay, how does that work with the layers in the index?
Well, you group similar inventory items into pools. Then at the end of each year, you value the ending inventory in the pool at current year cost and also at base year cost, the cost that existed when you first adopted dollar value LIFO. Comparing these two values gives you a measure of the price change for that pool, essentially, and an internal price index.
Yes, you figure out how much prices went up for that pool.
Right. Then you compare the ending inventory at base year cost to the beginning inventory at base year cost. If it increased, you have a new LIFO layer measured in base year dollars. You then multiply this base year dollar layer by the price index for the current year to convert it into a current dollar LIFO layer. This index layer gets added to the previous total dollar value LIFO inventory balance.
Wow, okay. That involves a few steps. The examples in the source seem helpful here. Example 9, Brocco.
Yes, example 9 illustrates this with an internally computed index. In year 1, their ending inventory at current cost is $54,000, and at base cost it's $45,000. So the index is 54K, 45K equals 1.2, or 65 as the source uses fractions. The increase in inventory at base cost was $5,000, 45K and 40K beginning. You multiply this $5,000 base layer by the index of 1.2 to get the year 1 dollar value LIFO layer of $6,000. This gets added to the base inventory. It sounds complex, but it systematically applies LIFO principles to a dollar pool while adjusting for inflation.
And sometimes the index is just given, like example 10.
Yes. In other scenarios, particularly for smaller companies or specific industries, the price index might be provided by an external source, like a government agency. The Bureau of Labor Statistics publishes some, or an industry organization. In that case, it's simpler. You still calculate the increase in inventory at base year cost, but then you just multiply that base year dollar layer by the given price index, like the 1.10 in example 10 for Walt Company, to get the dollar value LIFO layer. It achieves the same goal, applying LIFO principles more practically to a fluctuating dollar pool of diverse inventory.
So it's LIFO, but adapted for the real world of complex inventories, using dollar pools and inflation adjustments. That makes a lot of sense for large, complex businesses that want or need to leverage LIFO, likely for tax reasons. Okay, what about the gross profit method? When would a business use that and how does it work? It sounds like an estimation technique, which is a definite departure from precise tracking or even detailed LIFO layers.
It is absolutely an estimation technique. The gross profit method is primarily used in two main situations. First, for preparing interim financial statements, like quarterly or monthly reports, when the company uses a periodic inventory system. Doing a full physical inventory count every month or quarter is often too burdensome or expensive, so they use this method to estimate inventory and COGS for those interim periods.
Okay, for quick internal or interim reports.
Second, and perhaps more dramatically, it's used when inventory needs to be estimated because a physical count is impossible or impractical due to some unforeseen event. Think about a fire, a flood, or some other disaster that destroys the physical inventory or maybe even the accounting records related to it.
Right, you have nothing left to count.
Exactly. In those situations, instead of a physical count, you use the company's historical or expected gross profit percentage to estimate the cost of goods sold and, by extension, work backwards to estimate the ending inventory or the inventory that was destroyed.
How does that calculation work?
The logic is pretty straightforward. If you know your total sales revenue for the period, which you might reconstruct from bank records or other sources, and you know your company's typical gross profit percentage based on past performance or budgets, you can estimate your cost of goods sold.
Because gross profit equals sales COGS, yes.
Exactly. So if a company historically makes a 20% gross profit on sales, it implies that its cost of goods sold must be 80% of sales. 100%, 20%. So if sales for the period leading up to the fire were, say, $200,000, you'd estimate the cost of goods sold as $160,000. 200,000, 80%.
Okay, estimated COGS, yes. Then what?
Then you use the basic inventory formula we discussed earlier. Beginning inventory, which you know from the last period's records, plus purchases, which you might reconstruct from supplier invoices, gives you cost of goods available for sale. Subtract your estimated cost of goods sold, $160,000 in our example, from the cost of goods available for sale, and the result is your estimated ending inventory, or the estimated cost of the inventory destroyed in the fire.
Ah, you back into the inventory number using the estimated COGS.
Precisely. Example 11 from the source shows this clearly for Dalco. It allows for a quick and reasonable estimate when an actual physical count isn't feasible. It's crucial for things like insurance claims or just getting interim financials out without a full count. It's the business world's equivalent of figuring out how much flour was in the pantry before the earthquake knocked everything over.
That's incredibly practical for emergencies or just for saving time on interim reports. Okay, finally, something that sounds like it could be a potential trap or maybe a hidden liability lurking on the books. Firm purchase commitments. What are these exactly, and why do they matter so much for inventory accounting, even if the goods haven't been received or paid for yet?
Right. These are important and relate back to that conservatism principle. A firm purchase commitment is exactly what it sounds like. A legally enforceable agreement, a contract to purchase a specified amount of goods at a predetermined price at some point in the future. It's a non-cancelable contract. You're locked in.
Okay, so you're legally bound to buy something later. Why is that an inventory issue now?
It becomes an inventory accounting issue now if something happens to the market price before you actually execute the purchase. Specifically, if the contracted price you're locked into paying exceeds the current market price for those same goods at the end of an accounting period, and therefore a loss is expected when the purchase is actually made later, that expected loss must be recognized immediately.
Immediately, even though you haven't bought the goods or paid the money yet.
Immediately. In the period the price decline occurs. You don't wait until the goods are actually delivered or the purchase transaction happens next year. Why? Because the company is legally bound to pay a higher price than the current market offers. This represents a probable future economic sacrifice and unavoidable loss stemming from that contract. Recognizing it now adheres to the conservatism principle. Recognize losses as soon as they are probable and estimable.
Wow, so you're essentially booking a loss for inventory you don't even have yet, just because you're locked into buying it at what is now an unfavorable price.
Exactly. Example 12 in the source illustrates this perfectly. J&S Inc. signed a contract in year 1 to buy timber for $5 million with the purchase to be executed in year 2. But by December 31st of year 1, the market price for that same amount of timber has dropped to $4 million.
So they're locked into paying $1 million extra compared to the current market.
Precisely. That $1 million difference, $5 per contract price, $4 market price, represents an expected loss on that purchase commitment. This $1 million loss must be recognized in year 1, the year the price declined and the loss became probable.
How would they record that?
They'd make a journal entry debiting an account like estimated loss on purchase commitment, which hits the income statement, and crediting a liability account like estimated liability on purchase commitment, which goes on the balance sheet. This ensures the financial statements reflect the economic burden of that unfavorable contract as soon as it's known. It's another powerful example of how accounting tries to anticipate and report economic reality, not just transactions that have already fully occurred.
That's a really powerful financial implication. It underscores again that inventory accounting is far more intricate and impactful than most people probably realize. It's not just counting boxes in a dusty room. It's a dynamic financial battlefield where contracts, market fluctuations, and accounting choices can hit your bottom line before the goods even arrive at your door. Hashtag outro. Well, you've definitely done it again. We've navigated the surprisingly complex landscape of inventory. We went from its basic types through all those thorny issues of ownership, FOB this, consignment that, and valuation methods, the write-downs, the tracking systems, right down to the intricate cost flow assumptions like FIFO and LIFO, and even the surprising impact of future purchase agreements.
Yeah, it covers a lot of ground.
What really started as seemingly simple stuff has definitely turned into understanding a strategic financial asset, one with a huge impact on a company's reported bottom line, its balance sheet health, and even its tax obligations.
Indeed. It's quite remarkable, isn't it, how the seemingly mundane task of managing and accounting for inventory requires such a deep understanding of legal principles, like title transfer, valuation methods, cost, LCM, NRV, specific accounting rules, and even economic forecasting to some extent.
Yeah.
It really highlights that accounting isn't just about crunching historical numbers. It's about trying to reflect current economic reality, anticipating future events where possible, and ensuring transparency for everyone looking at a company's financial health.
So what does this all mean for you, our listener? Well, next time you walk into a store, or maybe more likely, next time you're reading a company's financial report or listening to an earnings call, you'll have a whole new appreciation for the intricate journey each item of inventory takes, both physically and on the accounting books.
Hmm.
You'll understand maybe why a company might choose FIFO over LIFO, or vice versa, especially if they're in the U.S. You'll know why their inventory value might seem strangely low compared to current prices, or why a sudden loss might appear on their income statement related to goods they haven't even received yet due to those purchase commitments. It's really a testament to how deeply intertwined a company's operations and its finance and accounting functions truly are.
And building on that, it raises an important question for you to consider as you look at financial information. Knowing the significant impact these inventory valuation choices, FIFO, LIFO, average cost, can have on a company's reported net income and its ending inventory value on the balance sheet. How might you, as an investor, a lender, or just an interested stakeholder, use this knowledge to better interpret those financial statements? How can you adjust or read between the lines to truly understand a company's underlying operational performance, especially during times of volatile or consistently rising prices?
Yeah, how do you see past the accounting method to the actual business health?
Exactly. It's not just about taking the reported numbers at face value, but understanding the assumptions and methodologies baked into them.
That's a great thought to leave everyone with. We really hope this deep dive has given you some amazing insights into the world of inventory and maybe a new lens through which to view the business world. Until next time, keep learning, keep diving deep, and stay curious.